Ladies and gentlemen, good day and welcome to the Aether Industries Limited Q1 FY23 earnings conference call hosted by HDFC Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nilesh Ghuge from HDFC Securities. Thank you, and over to you, sir.
Thank you, Michelle. Good evening, all. On behalf of HDFC Securities, I welcome everyone to this Aether Industries conference call to discuss 1Q FY23 results. It is pleasure of having with us top management team from Aether Industries, represented by Dr. Aman Desai, Promoter and Whole-Time Director, Mr. Rohan Desai, Promoter and Whole-Time Director, Aether Industries, Mr. Faiz Nagaria, CFO, and Mr. Ravi Bhojani, Lead Investor Relations for Aether Industries. Without further ado, I will now hand over the floor to the management for making opening comments. Over to you, Ravi.
Good evening, everyone, and thank you, Nilesh, for the introduction. On July 25th, 2022, our board has approved the result for quarter first FY23, which ended on June 30th, and we have released the results on the same on the stock exchange as well as updated on our website. Please note, this conference call is being recorded, and the transcript of the same will be made available on the website of Aether. Please also note that the audio of the conference call is copyright material of Aether Industries Limited and cannot be copied, rebroadcasted, or attributed in press or media without specific and written consent of the company. Let me draw your attention to the fact that on this call, our discussion will include certain forward-looking statements, which are predictions, projections, or other estimates of future event. These estimates reflect management's current expectation on future performance of the company. Please note that these estimates involve several risks and uncertainties that could cause our actual result to differ materially from which is expressed or implied. Aether Industries or its official does not undertake any obligation to publicly update any forward-looking statement, whether as a result of future event or otherwise. Now I hand over the call to Dr. Aman Desai to share the updates. Over to you, Dr. Aman.
Thank you, Ravi. Good evening, everybody. I hope everybody is doing well, and I'm very happy to connect with you, discuss the performance of our company for the first quarter of the fiscal year 22-23. Let me begin by sharing the ongoing expansions and the current near future strategy of the company going forward. And then I'll request our CFO, Mr. Faiz Nagaria, to cover the financial highlights for the period under review. And then finally, Mr. Rohan Desai will wrap up and talk on a very high level about Aether's business. So I wanted to kind of touch base upon the various expansion activities that we have already talked about in the previous calls and that are going on aggressively on the R&D front and the pilot plant and the production front. And these are on track and on plan. The third manufacturing facility, our Site 3, which is the next greenfield manufacturing facility, which we have talked about always and showed to many of you, is completed in the civil construction, and we have started installing the reactors in the facility, and we are on track and on plan to finish this new greenfield manufacturing facility and commission this facility by the end of this calendar year, December 22. And we expect to have revenues contribution from this new manufacturing facility in the fourth quarter of this fiscal year. That is January, February, March of 23. As mentioned before also, we are launching 5 new products in this facility, which combined have a conservative market potential of about 1,200 crores imports into India, which can be proven by any simple data analysis of import data. The average selling price of these 5 new products will be higher than the current product basket that Aether has in the large-scale manufacturing business model. And also then looking at the demand of these products, which we are going to be manufacturing and launching for the first time in India, we are launching one additional product of these 5 products in the current manufacturing facility on a limited scale to validate the process in the existing manufacturing facility at production scale, so that when the new plant is commissioned, we hit the ground running in the production, and we can immediately start the revenues from that particular product, which will be the first one in the greenfield site. Very interesting and very recent development in the Site 3 manufacturing site is also that we are in advanced discussions to acquire a plot of land, which is about 2,500 square meters, which is right adjacent to Site 3. This is very interesting because this will be right adjacent to Site 3, and therefore will share all the utilities and share all the resources of Site 3. And we don't need to go into an additional greenfield manufacturing site for the same. And so this will immediately give us increased capacity from the Site 3 itself. In the Site 4 that we have also always talked about, documentation is well in process, and we are kind of wrapping the documentation up, and we will be starting the civil work and the construction work in the Site 4, which will be the second greenfield manufacturing site after the monsoons end. So aggressive and expansion plans on the production side, and we are on track and on plan. We have already finished a double expansion of the R&D, as we already mentioned in previous calls, and that is fully commissioned and fully handed over. And we are in the process of finishing the triple expansion by the end of the next month. We'll be installing 55 new fume hoods in this expanded R&D facility, which if you compare to the 18 fume hoods that we had for the fiscal year 22, it's a significant expansion in the R&D, and we are very confident on the pipeline of our various business models to fill up this R&D. In terms of the R&D expenditure, we continue to expend significant amount of resources and money towards R&D. Our quarterly expense of R&D was up to 6.92% revenue plus capital as of R&D expenditure as a portion of the overall revenues. And we are also aggressively hiring scientists and engineers, PhD levels and master's levels in the R&D. We have also acquired a plot measuring 1,500 square meters, approximately near our R&D and pilot plant site for future expansions of the R&D and pilot plant as well. And the pilot plant has already been expanded to 3x times with more than 100 reactors installed and fully commissioned now, and it's amongst the world's largest pilot plants. And so R&D, pilot plant production, aggressive expansion plans, and we are on track and on plan with all these expansion plans. The 16 megawatt solar power plant commissioning is complete, and we have started getting the power supply from this. This will help save us 50% of our electrical load, supply like 50% of the electrical load from solar energy, and we will offset 24,000 tons of carbon dioxide per year. Our three business models continue to be robust, and we continue to equalize these three business models. Large-scale manufacturing has been the driver, and I've already mentioned the 5 new products we are launching in this current year in the manufacturing Site 3 coming up. We also exhibited in Chemspec Europe and Germany and Chemicals America in Charleston, USA in the last 2 months and this quarter. And as predicted in the post-pandemic era, we see now a tremendous influx of CRAMS opportunities already. And this is already being evidenced by the reasonable growth in the CRAMS business model that we have in this quarter as compared to the last quarter or even the same quarter of last year. We continue to talk at the highest technical echelons of numerous multinational innovator companies across the industry spectrum, and this is a very promising space for us. And finally, the contract/exclusive manufacturing business model is also growing its share of the overall pie of our revenues, and we anticipate this to accelerate in the years to come. So this is a very high-level overview and update on our various expansions and strategies of the company. And now I'll hand over the call to Mr. Faiz, our CFO, to give you the financial highlights of the quarter 1 of FY23. Faiz?
Yeah, thank you, Dr. Aman. Good evening, all of you. I am glad to inform you all that we have achieved a total revenue of 166.16 crores for the Q1 of financial year 23, reflecting a growth of 13% over the previous quarter Q4 of financial year 22 and 10% over the Q1 of financial year 22. The sales revenue of the company increased by 9% from rupees 147.5 crores in Q4 of financial year 22 to rupees 160.01 crores in Q1 of financial year 23. The sales revenue of the company increased by 7% from rupees 150.02 crores in Q1 of financial year 22 to rupees 160.01 crores in Q1 of financial year 23. The average selling price of our products during the Q1 of financial year 23 has been at the north side of that which was in financial year 22. The company has been able to generate EBITDA of rupees 48.61 crores in Q1 of financial year 23 against rupees 47.49 crores in Q1 of financial year 22 and rupees 42.32 crores in Q4 of financial year 22, thereby showing an increase of 15% from Q4 of financial year 22. EBITDA margins have been at 29.25% for Q1 of financial year 23. The increase in revenues and EBITDA has allowed the company to capitalize on the PAT levels, which have increased by 18% from rupees 26.02 crores in Q4 of financial year 22 to rupees 30.63 crores in Q1 of financial year 23. We have capitalized assets worth rupees 43 crores during the year, and we also have capital work in progress of around 166.64 crores. The use of IPO funds is done for the capex for the greenfield project, repayment of loans from the banks, and various working capital requirements, which are as per the object clause which were defined in the prospectus. We have utilized the funds as per the object clause of the IPO. We utilize the funds as per the table, as per the details provided below. We have used around 200. We have drawn to 21 crores for our capex of the greenfield project 3, from which we have utilized 7.5 crores in up to 30th June, and remaining funds of 13.5 crores have been used in this current month, which is going on. Out of the 165 crores for the working capital requirement, we have drawn down 30 crores from the monitoring agency, and we have used all these 30 crores for the payments of raw materials and various other working capital requirements. The repayment of loan is already been done, and we had also informed you in the Q4 earnings call that we are a debt-free company as we speak, and today also we are a debt-free company. We are not utilizing any further term loans. We have no term loans pending in the company. Only the working capital requirements is required, and as per the object clause provided in the prospectus is being used. For the general corporate purpose, we have drawn down 56 crores, and these 56 crores have been used for various purposes like solar power and payments to various other utility payments and other things. Now I will request Mr. Rohan Desai to talk on high-level overview of Aether's business.
Thank you, Faiz, for the financial highlights, and we are committed to make these numbers look better in the quarters to come. Despite the various ongoing challenges like raw material costs and product volatility, increase in the utility costs like steam and energy costs, and lastly, the global geopolitical and economical situation, Aether is happy to announce that we have seen growth and upcoming demands in all the 3 business segments. We have also exhibited in ChemSpec Europe and Chem Outsourcing USA in Q1, as Aman suggested, which gave us a good idea of the upcoming growth and the opportunities for Aether. In the 3 independent business models in Q1 of financial year 2022 to 23, we have seen 53% of our total top line coming from large-scale manufacturing, 12% comes out of contract research and manufacturing services, which also funnels into third and interesting business model, which is contract/exclusive manufacturing, which contributed to 33% of our total top line. Our endeavor is to achieve balance between large-scale manufacturing business model and CRAMS and contract manufacturing and /exclusive manufacturing business model, so that we are not dependent on any single business model. Our sales mix stands as pharma 50%, agrochemical 34%, material science 4%, high performance photography 7%, coating 4%, and others as 1%. Our export stands at 69%, which includes export to SEZ and EOU units in India, and domestic sales stands at 31%. Exports outside the geography of India accounted for 38% of the total revenue from operations. Lastly, before we enter the Q&A mode, we at Aether would like to thank each and every one who has been associated with Aether and have put your trust and confidence in us. And we look forward to our interactions with you along the way and enjoying the journey together. Thank you.
Back to you, Ravi. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Saurabh from Asian Market Securities. Please go ahead.
Yeah, thank you for the opportunity. So if you can give some color about the top 4 top 5 molecules in terms of how the volume was in the Q1 and also realization for those molecules.
All the molecules have, Saurabh, thank you for the question. All the molecules have grown considerably well. We would not like to disclose the molecules at the moment because these transcripts are available in the public knowledge, and our competition is with China, so we would not prefer doing this. We can do it on one-on-one basis
if required be. And over the year end, we will give you all the complete colors in the call of Q4.
Okay. But there was volume growth, right, for most of the molecules?
Yes, the volume was growing. The contract/exclusive manufacturing has grown tremendously, and also the contract research and manufacturing services have shown a good growth over this quarter.
Okay. The 5 new molecules which you mentioned in your opening commentary, so have you launched all the 5 molecules, or the still trial production is on started or something?
Yes, so all the 5 molecules will be launched one after the other in the quarter 4 of this financial year, and it will be done in the matter of 1 month. And also, as Aman suggested in this call, the first molecule is going to be launched in this quarter.
So 1 molecule in this quarter and the rest in the Q4.
Yes, so 1 molecule is launched in a limited capacity, just to have to complete the learning curve in the existing facility where we have an opportunity. Hence, we are launching it before time.
Okay. So now coming to the margin performance, so now we have seen decline on Y-on-Y basis, also on Q-on-Q basis. So was it attributable to the higher cost, and should we assume that with a pass on of the higher cost, we should see normalized margin from Q2 or Q3?
Yeah, I'll take this question. So you are right that the reduction, actually there is no reduction in the margins from our per se. But if you are comparing the margins because of the Q1 of financial 2022 and financial 23, of course at that time the raw material pricing was quite low, and after that from quarter 3 of financial 22 the pricing of the raw material started increasing, and that increase is still being felt, and the raw material which we have used in this quarter, the quarter first of 23, the materials which are procured in the last quarter of 22 were used. So now what material we have purchased in this quarter are considerably at a lower price than what we had purchased in the last quarter. So we are definitely going to get this better margins in the next quarters, because we will be using the raw material which has been procured at a lower price.
Okay. And how is the utilization level? So can we further improve on the current quarter revenue unit for next 2 quarters till our site 3 gets ready?
Capacity utilization is around 70% for the first quarter for us, and we have a lot of ample of opportunities to ramp it up, and as we have told in the last call also, that we can go up to maximum 90% and 91%, and keep 9%, 8% for our any kind of contingencies. So we have room, and we would be ramping up these capacities.
Oh, okay. Thank you.
Thank you. Reminder to all the participants to press star and 1 to ask a question. The next question is from the line of Girish Bakru from OrbiMed. Please go ahead.
Yeah, hi, thanks for taking my question. So just on the molecule side, I know you're not disclosing the molecule-wise growth, but the top 7, is the contribution still same around 76-77%, or has that changed in this quarter?
Yeah, the contribution is the same. I mean, the margin contribution is the same. For us, there is no change in this quarter.
And overall, pharma is 50%. I was under the impression that pharma will eventually increase gradually in the mix. It has actually come down. So if you could guide where let's say, the volatility is coming from in terms of the mix changing.
Yes, Girish, you are right. But as you see, you're comparing it with the last year. There are 3 more quarters left for this year, and we will see the pharma being picked up because the 5 new launches are happening also in the last quarter. Also, we are launching one out of these 5 molecules in this current quarter. Hence,
The pharma will take a lead in the next 3 quarters, but our endeavor is to have a balance of 50/50 between the CRAMS, contract research and manufacturing services, and exclusive manufacturing and large scale manufacturing. That's the endeavor which we believe that the outcome will come to this desired levels in the next 2 years' time.
So in the exclusive manufacturing bit, if you can give more color, my understanding is that it's largely agrochem. Is there any pharma company in exclusive as well?
No, so it's majorly agrochem only on contract research exclusive manufacturing. Also, we have oil and gas in contract research exclusive manufacturing. So majorly agro is the base of contract research exclusive manufacturing.
Right. And 5 molecules that you announced, I mean, total pipeline over the next 3 years, what is it looking like? If you could give some color there.
Yeah, so 5 molecules which are launching is in the current calendar year, and then the next calendar year we have another set of molecules which we'll be launching. We'll be announcing that very soon. However, on the R&D side, we have 18 molecules in the pipeline, and that is what the pipeline looks like in the R&D.
And these are largely pharma, right?
Pharma, agro, material science, and oil and gas.
Okay. All right. Thank you. I'll join with you. Thank you.
Thank you, Girish.
Thank you. The next question is from the line of Rohit Sinha from Sunidhi Securities. Please go ahead.
Yeah, hi sir. Thank you for taking my question and congratulations for good set of numbers. So my question would be on the business segment. I mean, out of these 3 segments, I know it would be not advisable to pinpoint the margins, but are these all 3 business segments having a similar margin or have a different margin? And going forward, when we are seeing that with this new capex coming up, how this after 2 years down the line, how these business segments contribution would be lookalike in the overall revenue mix, and subsequently definitely how margin profile would be looking.
Yeah, Rohit, thank you for the question. I could not hear half of your question, but I will try and answer it. And correct me if I'm wrong or I'm going out of the way on this answer. So the 3 business segments are large scale manufacturing, which is approximately having a margin of 28 to 30% EBITDA margins. We have contract/exclusive business model, which also has the similar margins, whereas contract research and manufacturing services, which is called CRAMS, has a 70% EBITDA margins for us. And looking to the new launches, the launches will be in the large scale manufacturing business model, which will be in the north of 28% EBITDA margin.
Okay. And the mix would be, this 50% large scale and 33% CRAMS, 12% CRAMS and 33% contract manufacturing. So these would largely remain in the same line, or there would be some kind of skewness towards maybe CRAMS, what we will be focusing going forward?
No, our objective is to equalize all these 3 business models. We'll be lucky if we can do it in this year, but our endeavor is to equalize it as fast as possible so that we have any of the business model individually. We are trying our best to do this, and we hope that we will be able to achieve it in the future.
Okay, sir. That's helpful. And secondly, when we say 50% as of now is our pharma contribution, so would it be possible to segregate between that as domestic and export also? I mean, out of that 50%, how much is export and how much is domestic?
We do not have it handy right now, but we can connect on a separate call and give you this information.
Okay. Then in export part, since 69% is export, so geography-wise, would it be possible to share the detail at which region we have the maximum exposure as of now?
Yeah, I'll take this. So actually, this 16% also includes exports to SEZ units in India and deemed exports, which is also in the Indian territories, but they are considered as exports. So if you see geography as in India, it is only 43% and 57% in India and 43% is pure exports.
Okay. That is deemed. Okay, got it. Got it. And sir, ultimately, I mean, after this, all these capexes coming into stream by 24 or 25, what sort of revenue size we will be targeting?
We have on the site 1 and 2, we have achieved 600 crore top line last year, 590 crores of top line. So imagine 2 more sites coming in with a production capacity of 6,000 tons, and imagine 9,000 tons capacity coming up in the calendar year 23 and calendar year 24. I believe, Rohit, you can do the math yourself.
We cannot give any future or forward-looking statement.
Got it. And how quickly we can scale up to this capacities? I mean, utilization level, how much we can scale within maybe 6 months or a year, and when we can reach up to the peak utilization?
So the utilization of 50 to 60% can be achieved in the matter of 2 years.
50 to 60% in 2 years?
Yes.
Okay. And this 9,000 is the additional capacity, I mean, apart from 6,000?
Yes.
So total it would be 15,000, correct?
Yes.
Okay. That is from my side. I'll come back in. Thank you.
Thank you.
Thank you, Rohit.
The next question is from the line of Kalpit Narvekar from Alliance Global Investors. Please go ahead.
Hello, sir. Congratulations on the numbers and thanks for taking my question. So, firstly, on the mix change that happened this quarter on contract manufacturing being higher versus, say, exclusive, right? So, could you share some color on whether there was some kind of degrowth in the large scale in the exclusive in the large scale manufacturing business, or was it just driven by very strong growth? Because you're saying that you didn't add any customers, right? Only agrochem were the customers. So some color on that would be helpful.
Yeah, so there's no degrowth or there's no less growth in the large scale manufacturing. The growth is going on as we are manufacturing the products as per the orders we receive. We do not put in the inventories of finished goods more with us. Only the raw material inventory put on. So there is no degrowth in any of the sectors. Of course, CRAMS has gone up this time more, and that is good for us because it is more margin driving cycle or segment. So there is no degrowth in any of the segments. And we will, as we have told that the new facility is coming up, it is going to be towards all the profile products are towards large scale manufacturing. So that will again ramp up the large scale manufacturing, and it will end up with the highest revenue generator for this year also.
Okay, and my second question was, are there any order wins or anything in the contract manufacturing piece?
Any other?
Can you repeat the question?
Any order wins from any large clients or anything? Any updates on the order side?
No, so we have not seen any order risks from large clients as of today. We are already in touch with all our customers on regular basis, and we see no such thing happening at the moment.
Okay. And could you explain the seasonality in the business? So, like, just to understand the utilizations during the year, which quarters do you usually see higher utilizations? Because QOQ, the utilizations came off versus last quarter, right? At 70%. So I guess you were talking about maybe 77, 78% last quarter, right? If I'm not wrong. Yeah.
Yeah. So it really depends on the composition of the products. I mean, so if you're making a high value product, your capacity utilization will get decrease in various ways, and so it is very tough to predict capacity utilization on quarter-on-quarter basis and predict how it will happen in the next quarters to come.
Okay, thanks. That's very helpful. Thanks.
Thank you. A reminder to all the participants to press star and one to ask a question. The next question is from the line of Nitesh Dhoot from Prabhudas Lilladher. Please go ahead.
Hello.
You're audible. Please proceed.
Good evening, sir. So, actually, sir, my line got dropped off. My question is on capacity utilization for the first quarter. So I'm not sure if you've already answered, but what was the capacity utilization?
It's 70%.
Okay. And sir, would it be fair to say that the contract manufacturing growth was led majorly by BFA, that is bifenthrin alcohol, in this quarter?
There are two products already mentioned in the contract manufacturing / exclusive manufacturing space, and both have led this growth.
Sure. And also, if large scale manufacturing, where the revenues have largely remained flattish sequentially as well as on a year-on-year basis, is there some demand sluggishness across key molecules?
So the pharma sector has shown quite a good volatility, but we were unaffected and we remained on the stable position at the moment. So we are already in touch with all of our customers on regular basis, and we do not see the struggle in the pharma space as of now for Aether.
Okay, so how do you see the rest of the year shaping up as far as large scale manufacturing is concerned?
We see the prices of all the commodities coming down for the next 2 or 3 quarters and stabilizing to the original levels if possible. I mean, we would be lucky if it stabilizes to the actual level. However, we see a good next 3 quarters per se, in terms of the demand and in terms of the raw material pricing.
Okay, so thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Hi, good evening, and thanks for the opportunity. My first question is in terms of contracts. So, how are the contracts shaped up in terms of if there is a pricing volatility for a short period? Do we get compensated for the same, or whether we have to absorb it? And generally, what is the contract period for all our products? I mean, is it normally a 6-monthly, yearly contract with some volume commitments and price reset on particular intervals? Thank you.
Hi, Rohit. Yeah, so great question. We have multiple types of contracts. We have multi-year contracts, which is price reset at every 1-year interval. We have a yearly contract where we can go and discuss on the price on quarterly basis if required be. And then we have 6-monthly and quarterly price agreements which we have to adhere to. So if there is orders of 3 months to 6 months, we have to adhere to the price and we cannot go and change the price.
However, the inventory levels of 4 to 5 months is helping us to maintain that contract and deliver the material at the defined price. However, the contracts do not include the steam cost or utility costs. It does not include commodity prices changes like caustic soda lye and flakes. So we have to take that kind of hits into our margins because there is no way out. Also, at certain places, if the contracts are in the local territory, that is domestic, and the material is being imported, you have to take a risk of the dollar versus Indian currency exchange rate. However, if it is an international contract, we can renegotiate the pricing based on the currency movements. Did I answer the question, Rohit?
Sir, we have lost the line of Mr. Rohit. We'll move to the next question, which is from the line of Bhavya Gandhi. Please proceed.
Yeah, thank you so much for taking my question. Sir, if it's possible to answer, what would be the ROC of each business segment? Say, for example, large scale, what sort of IRRs or ROC levels we generate for each segment? That is my first question. So you mentioned about the margins, 28 to 30%, but on the ROC level?
The ROC levels of the individual business segments will not be possible for us to give. We have not done that study, but we can do that and connect again with you on a separate call. However, we have this information is readily available with us right now.
Sure. And sir, on the debtor days, is it possible to throw some light for each business segments? How are the debtor days for each segment?
No, each segment we do not separate out segment-wise debtors because even there is overlapping of the customers in various models. So it is not possible to give the separate debtor days in the separate models.
Okay, fair enough. My last question would be regarding your R&D. Say, for example, you are bringing in new molecules. So how do you assess which molecule to bring in? Is it based on is there a ready market available? Is it the size of the molecule? What are the factors that we sort of decide before entering into that molecule?
Aman, can you take this up?
Yeah, basically, there's multiple factors that are considered. For the last case, we look at the import component first. There are various criteria for selection. The fact that nobody else in India is making these products, one of the most important criteria we follow. The good fit for our competencies of chemistries and technologies, and so we retain the 8x8 metrics of chemistry and technology competencies and try to remain within these competencies. There's an attractive pricing of the molecule on the basis of our techno-commercial evaluation. There's attractive volumes coming in. There's multiple customers of that molecule. So these are some of the criteria for selection of molecules and products for the large-scale manufacturing business model. In the CRAMS and contract manufacturing business models, these identification of projects are client and customer driven and guided, and we usually engage with the customer in joint identification of appropriate targets in the pipeline and the launch molecules portfolio of the various customers that we work with. And so that's the very high level idea of how we go about selecting these molecules. Hello. The question.
Yeah. Can you hear me?
Yes.
Yeah. And sir, one more question. Last question is, we have what 2,500 square meter land, right? So isn't it small in terms of size?
Can you repeat that question?
So we bought 2,500 square meter adjacent to our existing site. Isn't it small in terms of size? So are we planning some small capex? How is it like? Because 2,000.
So the current site is about 6,000 square meters, site 2, and which has a smaller production capacity as compared to the current production capacity that we have. And so from the perspective of the 6,000 square meter site, 2,500 square meters is a reasonable amount. And you have to remember that all the utilities and all the resources will be shared in the same site. And so from that perspective, we're talking about one manufacturing block that can be fitted into that additional site by the sharing of all the resources and the utilities and the manpower and the waste treatment plants of the existing site. And so from that perspective, it's not a trivial purchase.
Okay, and fair enough. And sir, do we look internally for CFO versus EBITDA? Because our cash flow from operation conversion is quite low.
Mr. Gandhi, we cannot understand what you're speaking as you're speaking very close to the speaker.
Okay, now can you hear me?
Yes, please go ahead.
So sorry. So do we internally monitor cash flow from operations to EBITDA? Because that seems to be on a lower side.
Yeah, you are right. We do monitor all the cash flows from operations also, and EBITDA, we all have the cash accruals worked out every month-on-month basis. And you are right, it is low, but this is going to be changed after the IPO which is received and the working capital cycle improving, be much in better shape than what is being seen in the last year and this current quarter also.
Okay, fair enough. And what working capital cycle do we expect going forward?
At least 120 days.
120 days. Thank you so much. Yeah, that's it from my end.
Thank you.
Thank you. The line of Mr. Rohit Nagraj have been connected now. Mr. Nagraj, please proceed with your question.
Yeah, am I audible?
Yes.
Yeah, thank you. Yeah, so I was asking about the second question. So we've been to some of the trade shows and we have our overseas business development people. So what is the sense that we are getting currently, given that in Europe there are issues, in US there are some inflationary pressures. So across the geographies, what is the sense we are getting from new product development perspective and opportunities? Thank you.
Shaman, would you like to take it up? Yeah. Yes, I can take this question up. It's a great question, Mr. Nagraj. The problems that are happening in the US and Europe are at a very macro level. At the micro level of our industry and the chemical industry, there is absolutely no difference that has been found. Rather, there is only positivity and optimism that has been found. In the post-pandemic era, the external research programs and external research work is getting started aggressively and with vengeance, because it was all cooked up the last 3 years. And so from the European and the American shows, both of which we exhibited in, we have had a tremendous inflow of opportunities, and that has actually translated into project proposals and activated projects, new projects on the CRAM side on a significant front. And so that all has actually happened. These tremendous influx of opportunities and promising meetings have actually translated into active projects that are currently going on right now in the CRAM space with various innovators across the industry, some of which we have started relationships and projects for the first time actually in the last 3 months. And so from that perspective, it's been very promising. We are not seeing any negative impacts and any downward trends. Rather, it's quite contrary to that.
Got it. This is really encouraging. Just one clarification. So in the press release, we mentioned that we are a member of UN Global Compact. So what exactly is the advantage from this, and how is it different from the other certifications or so, or something like a TFS or so? Thank you.
Rohit, can you repeat the question? We lost you quite a bit.
Sorry. Is it better?
Yeah.
Yeah. So in our press release, we have mentioned that we are a member of UN Global Compact. So how this particular membership is different from, say, TFS or other memberships, and does it help in terms of our mentioning our capabilities in the overseas market? Thank you.
Yeah. So UN Global Compact is actually a platform wherein various companies are joining their hands and they will be working towards common goal of CSR, corporate governance, and various ESG initiatives. It is basically towards mostly towards the CSR activities, wherein all the large corporates are joining hands and initiatives will be taken on a global level to do CSR activities.
Okay. Thank you. Thanks a lot and the best of luck.
Thank you, Rohit.
Thank you. The next question is from the line of Ranjit from IIFL Securities Limited. Please go ahead.
Yep. Thank you. Hope I'm audible.
Yes, you're audible, sir.
Yep. So quickly wanted to get a sense whether it would be possible for us to share the large-scale cramp and exclusive manufacturing revenues for the first quarter of FY22. The reason I'm asking this is that we have said that our exports, including the SEZ sales, are up around 17% YOY. But when we look at the overall revenues, it is only up around 6-7%. So it's clearly the domestic segment, there seems to be a bit of pain. So just wanted to understand where and in which specific segments are we seeing a bit of subdued sales.
You're talking about Q1, right?
Q1 of 22.
Yeah. Q1 22.
That information we have not separately worked out because it was not relevant to this Q1 numbers. That's right.
Sure. In that case, then just wanted to get. Sorry. Go ahead.
Yeah, on a separate call we can connect and we can give you these details if you want.
Sure, would be happy to connect. Just wanted to get a sense that since the release mentions that the exports are up almost 17% and then the overall sales are just 6-7%. If you can highlight in which specific segment on the domestic side we have seen a bit of subduedness and the outlook on the same, whether things have started to improve on that front. Thank you.
Yes, the domestic sales, as I told even in the beginning also, that if you see a geography-wise breakup, sales into India and sales out of India, in India sales is accounting for around 62% and export is only 38%. So in the export sales, we are including DM export and SEZ sales, which are also part of India only. And domestic sales, we are definitely increasing. It's not that we are focusing more on the export market, on export sales. It is mostly both are on a parallel side, if you see.
So I want to get a bit more clarity within domestic since we are also giving a bit of more bifurcation with pharma and agro. So it is the domestic pharma or domestic agro where we have seen a bit of subdued sales?
Sure, we will definitely share this also in a separate call with you.
Sure, thank you. And the final question, we have shared an order book of 246 crores. So what is an executable timeline for this particular order book?
246 crores are for this current year. We do not take any further years into consideration when we consider our order book because that's more of an indicative or futuristic order book. So what we are looking at is the order book which is to be completed in this financial year. And we are holding that approximately at 226 crores as of today.
These are the fixed commitments that we would be able to execute during the year. And there would be an addition to this order book because there would also be a spot sale that we keep on doing it.
Yes, and absolutely. And every month you add or every week you add orders onto this order book. So it's an ongoing process. So it's a never-ending story. After maybe in the next quarter also it would be in the same range.
Is there any difference between the order book margins and the ones that comes which is excluding this order book margins, or the margins should be largely be similar?
Margins would be largely the same.
Sure, sir. Thank you.
Thank you. The next question is from the line of Gagan Thareja from ASK Investment Managers. Please go ahead.
Yeah, good evening. I hope I'm audible.
Can you speak loudly, please?
Yeah, is it better? Can you hear me now?
Yes.
Okay. So my first question is on the sales growth of 8.5 of around 7 odd percent for reported for the quarter. How much have the sales volumes or tonnage grown, and how much has pricing contributed to sales growth?
So it is a mixture of tonnage and there's no, as we have mentioned in our speech also, the pitch also, that the average pricing of the products is at the same average selling price which was there in the financial year 22. So it's morely of growth driven by volumes.
Okay. And on the input prices, you indicated input prices remain elevated year-on-year comparison-wise. How high are the input prices compared to the first quarter of last year? And if possible, could you give some idea on solvents and KSMs and utility prices separately? How high they are compared to the same quarter?
Yes. So last quarter, if you see our margins also, we have mentioned that the raw material costing was around 47-48%, which has gone up to 55% in this quarter. So this is basically because of the raw material pricing which was increased, which was in the third and the fourth quarter of financial year 22. The raw material is being used by us in this quarter for production. So that is the major factor of for the same. And the utility prices, of course, that also have increased due to the crude and oil, and also due to the dollar factor. And those prices have not, they have an impact, but that has been our impact on our EBITDA. But the raw material pricing, we were able to pass it on to our customers. So the major impact which you are seeing in the EBITDA levels is because of the utility pricing which has gone.
Okay. So in your pricing, in your contracts on as far as pricing is concerned, are you able to have price escalation clause for key starting materials, but are you also able to have price escalations for solvents and other inputs?
No. So we are only having price escalation for key starting materials and major contributors. However, till today, we do not have all the molecules, all the raw materials of the particular product written down with the CC ratios. Also, on all the contracts, these are our own molecules. So we do not deem fit that we will give all the CC ratios to the end customers, because you are majorly giving all the recipe of a particular product to the customer, which we don't prefer to give.
Okay. But solvents by volume or by value would constitute a significant portion of your input materials. Could you give some idea how much would solvents be as a portion of total RM cost for you?
It really depends, but it can be in the range of 5 to 10% of the total molecule selling price. So there are many factors. In the specialty chemical field, it's not A and B equal to C. It's many A, B, C, D, E, F, which makes it as a Z basically. So there are a lot of products which contribute at various percentage levels, and all had seen an upward trend in the last few quarters.
Right. Last quarter, you did indicate that OTBN prices are under pressure. I also understand that 4-MEP prices are also sort of have come off. Is that information correct? And as of today,
information is right. OTBN is in pressure. However, MEP prices are not under pressure.
Okay. So year-on-year MEP prices sustain, but OTBN prices are lower. Am I? Yeah. Okay. And for the new capacities that will come on stream starting December of this year, what is at what utilization would you be breaking even on those?
Breaking even?
See, we should be able to break even at around 25% capacity utilization. That is for sure, because whatever the initial productions will be there, we would, by reaching 20-25% utilization, we should be breaking on. Then only it will be profitable for us to carry on.
Right. And the 5 molecules, which you intend to introduce with the commissioning of the new plants, if you could, give some idea to us around the competitive landscape, how many suppliers are there in those 5 molecules? Are they all from China? And, therefore also from a costing perspective or from a quality perspective, would you be having a USP?
Yeah. So I will take this question. Carbamazepine or carbamazepine intermediates have competition from China only. There are 2 Chinese manufacturers who are manufacturing majorly out there, whom we know of. Dolutegravir intermediate is again China, 2 manufacturers in China. And Ambroxol, there is only 1 manufacturer in China at the moment. And majorly all these molecules have competition from China.
Okay. But by and large, two suppliers, for on an average for each.
So conservative, let's take maximum 3 suppliers of each product.
And what's the volume of these products in Indian market? If you could give some, just a ballpark understanding of.
Yes, Dolutegravir would be in the range of 150 tons per annum.
This is for your for your intermediate.
1 second. I am talking. Yeah.
All the intermediates.
Yes. So all the intermediates combined together.
No. I mean for the intermediates that you will be supplying, I'm asking for the addressable volume markets.
Do you want individually or do you want combined?
Individually.
Yeah. So Dolutegravir intermediate would be 150 tons into India.
Mm-hmm.
Carbamazepine, oxcarbamazepine combined would be in the range of 2,000 tons.
Okay.
And Ambroxol will be in the range of 180 tons.
Okay. Great. Thank you, sir. That's all from my
Thank
side.
you.
Thank you.
Thank you.
Ladies and gentlemen, due to time constraint, that was the last question for today. I would now like to hand the conference over to the management for closing comments.
Thank you everyone for joining the call. We hope that we have covered most of your questions. If you still have any further questions, please feel free to reach directly to us. Stay safe. Have a great day. Thank you. Thank you everyone.
Thank you. On behalf of HDFC Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.